my name is David Buckland and I am the CEO of Montgomery Investment Management. Welcome to this week's video insight. The 2017 financial year was kind to global equity investors. In Australian dollar terms, the Montgomery Global Fund put on nearly 20% after expenses and outperforming the world markets by a little over 5 percentage points. Ever since President Trump's surprise election victory in November 2016, global share markets have performed extraordinarily well, while demonstrating very low volatility of returns. The calm in the markets may be giving investors a false sense of security, as major indices in the US, the UK, Germany, Hong Kong and India are regularly hitting all-time highs. Positive factors include emergency low interest rates in a lot of countries, reasonable economic growth, Chinese fiscal stimulus, and the removal of the European Union tail risk with Emmanuel Macron's presidential election victory in France. But it could be argued the risk-reward ratio is deteriorating when, for example, central banks, including the US, European Central Bank, Japan, China, the UK and Canada, have tripled their combined balance sheet from around $7 trillion in 2008 to about $20 trillion today. And excess liquidity in these major economies is turning down as the rate of money growth slows and inflation picks up. The US Federal Reserve, after hiking monetary policy 3 times in less than a year to currently around 1.25%, has announced for the first time since the quantitative easing process began during the GFC, it would in fact start the gradual unwinding of its $4.5 trillion balance sheet later this year. Trump's ambitious legislative agenda is looking less likely by the day. And finally, as we can see from the attached chart, after a big boost in 2016, China's excess liquidity, as indicated by the red line, has decelerated significantly so far in 2017. This is typically seen as a leading indicator for economic activity and the movement in house prices in China. While falling liquidity in China will likely be negative for asset prices in Australia, we are having trouble rationalising why the Australian dollar to US dollar exchange rate has bounced so hard to 78 cents at present. Sure, the Australian building cycle has done wonderfully well over recent years, taking over from our commodity cycle. And as the black line in the following graph illustrates, residential building approvals have been running typically at about 10% to 25% growth year on year over recent years. Note, however, how Australian residential building approvals has now started to turn down quite a lot on a year-on-year basis. This leading indicator requires caution, especially given Australia's household debt-to-income ratio is running at a record 190% and growing, and our wages growth is running at multi-decade lows. And despite challenging 6,000 points twice in recent years, both in April 2015 and June in 2017, it does not surprise us that the Australian Ordinaries Index, which currently at 5,800 points, is still well over 1,000 points from its all-time high, which was recorded nearly 10 years ago in November 2007. That's all I have time for today. Thank you for your attention, and please continue to follow us on Facebook and Twitter.